Hello, everyone, and welcome to tonight's cast of TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with our speaker, Rob Roy. I'll introduce Rob here in just a few moments, but first we need to cover off a few important details about the session. First and foremost, if you've seen any of our previous live sessions to date, whether it be a previous TradeFinder session or maybe an insiders meeting, and you've seen this before, the main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this on our website, so you can feel free to read it in full detail there. Or take a screenshot here if you like, but that's the main gist to take away. All right, we do have one method for asking questions for this session. It is brief at the end. Rob will go through his presentation and then try to address a few right at the end, but just know that if we don't get to your question, there's only so much time for this one, so there's nothing to do with the validity of your question. We just only have so much time. So as you can see circled on the screen there, we have the Q&A window. Feel free at any point throughout the session to write your question in through that window. And as I said, we'll try our best to bump it through right at the end. If it doesn't get addressed, then definitely feel encouraged to attend an insiders meeting where there's a much larger focal point on questions at the other half of the session. And Rob does a very good job at getting through all the questions on that session. We do have the chat window as well, so feel free to write through any support-related queries or anything else along those lines for other attendees to see. One note to make is that you see at the bottom there is the to. Be sure to change that from host and panelists to everyone. That way it'll be visible to all attendees. Other than that, I think that about wraps up all the important details. So at this moment in time, I'll introduce Rob Roy.
Thanks, Zach. Appreciate it. And let me go ahead and get my camera started so you can see my face. I don't know why that's a big deal, but here I am. All right, this is Rob Roy of Elliott Wave Options, and welcome to tonight's TradeFinder. Especially welcome to all of you that are live streaming on the various social media platforms. I'm not techie enough to know how that stuff all works. That's why we have Zach and other guys to help us along those lines. But do appreciate you spending some time with us this evening. What we're going to cover is a little bit of a look at the market, not just our market, but the international markets as well. And if you're not interested in the international markets, I still invite you to pay attention as we look at them, because all the securities that we look at are tradable on the U.S. exchanges. So even though you might not be super excited about trading a foreign market, you just want to trade the U.S. exchange, well, there may be a great pattern in one of the other markets that you can trade on our exchange. Then we'll do a review of any closed trade alerts. Got something pretty cool to show you tonight at our website. Elliott Wave Options, EWOTrader.com is the actual URL. Then we'll look at a review of our past case study considerations here at TradeFinder. If you've been following along with them, you know that the results have been pretty spectacular. We've only got a few that might be considered open, and we're going to close out most of those tonight. So we're not going to have a whole lot left. Then we'll look for a case study consideration for tonight. Hopefully you were with us last week when I pretty much kind of said, we're not even going to search for anything. We're just going to buy puts on one of the markets, and we put it to a vote. We let you guys vote as to which market that you wanted to buy puts on, because the market was overbought. And you chose the SPY, and hopefully you followed along with that, because boom, boom, 2 days in a row, nice downward move, did exactly what we thought was going to happen. So you should have had a really quick, nicely profitable trade if you followed along with that. So at the end, we'll open it up to a general Q&A, as Zach mentioned, with as much time as we have at the end. And usually that amounts to you guys asking us about your favorite symbols, and we tell you what our indicators may say about those. That's it. That's what TradeFinder is. So we look at the markets, we have a live Q&A, we look for trade ideas. So let's get started. And taking a look at the market today, you can see that we did have a down day today. Interesting intraday chart. We actually had a rally early in the day. Looked like we were going to take off to the upside, and man, that got sold into. And I was noticing yesterday there were no sellers. The sellers just backed off yesterday. And let's look at the volume, and I'll show you what I mean. You can see how low the volume was yesterday. And if you watched the intraday movements of the markets, I look at a 3-minute chart of the futures throughout the trading day, and there was just no selling. Sellers never stepped in. So we just kind of had this move to the upside throughout the day yesterday. Totally different story today. The sellers came back, but then you can see that they didn't come back in a big way, because we didn't even have average volume. We had higher volume than we did yesterday, but we didn't even get to average. So does the downward move today count? I don't think so. I don't think yesterday or today counts. And that's why we're just kind of right at this 450 level. So the market's trying to figure out where it wants to go from here. Are we going to use 450 as support and we're going to bounce from here and try to take another run? You can make all the arguments fundamentally as far as why that doesn't make a whole lot of sense, but that could be the only reason. Now, one thing to think about, and I'm a big believer in market sentiment, and when we got to the downside here, we hit the 61.8% extension on that zigzag. I thought we might go to 100%. We didn't yet. And then the market was just, the sentiment was so negative at that point in time. But in the last survey of Investors Intelligence, 57% of advisors were bullish. And that doesn't sound like a whole lot, but when you get to 55% that are actually bullish, that's viewed as being kind of leaning towards the bullish side. So sentiment has quickly gotten back to being very bullish. It didn't take a whole lot of time. And so the shorts have just sat back. They let that rectify itself. And I think today was a little bit of a test. They wanted to see, how, if we come in and press the bets, how easy would it be to push things back to the downside? And I don't think they found much resistance on the way down. So we're going to find out within the next couple of trading days whether we bounce from 450 to the upside or whether we give it up and we head back down towards those lows. I still feel like 400 has to happen at some point in time. I could be completely wrong, but I feel like that is a level because we have that gap going all the way back to the beginning of April last year. So an entire year ago, in order to close that. Now, historically, April's been a pretty decent month. May's not. So could we bounce from here, go to the upside, and then come back down May or June? Absolutely. Any of those things can happen. But if we put the Elliott wave pattern on, you can see we're not in a 5-wave pattern. So we're just figuring out the corrective moves right now and waiting for an impulse pattern to show itself. That's not enough of a retracement for me to pay attention as far as a zigzag back to the upside. So I think it's just prudent to be patient and see what the market gives. And when the pattern reveals itself, then we'll pounce at that point in time. And so I think that's the smart thing to do. So I don't really have a whole lot else to say about the SPY. We closed just below the 10-day moving average, but close enough to it that I don't think that's a big deal. I think the 450 level is more important as to where we closed today. I just thought it was interesting, the intraday dynamics where the sellers just took yesterday off. Today they came in and they got really no resistance from the buyers whatsoever. So are the buyers exhausted already on this move to the upside? Perhaps, and maybe that's it. And then we start to move back to the downside from here. We'll see. One of the things I did want to talk about tonight, and several of you mentioned this, and if you're live streaming on YouTube, please go to our channel on YouTube and take a look at our videos. And we put an awful lot of effort into those to try to give some quality commentary on the different markets that exist. And I try to answer every single comment that's made personally. And a lot of you actually were talking about this chart right here, which is the Dow Transports. And you were mentioning, hey, can you talk about that in tonight's TradeFinder? So yeah, you asked for it on YouTube in our channel. So here we are. We'll talk about it. And you're right. The transports are crashing. So this goes to Dow theory. What is Dow theory? I don't know if all of you have heard of it or not. It was created by Charles Dow, so it doesn't actually have to do with the Dow Jones, but basically it's the industrials and the transports. And if the industrials make a new high and the transports confirm it, then you're likely moving higher. Or if the transports make a new high and then the industrial average confirms it, you're likely going to a new high. So they normally talk about it from moving to a new high as far as Dow theory. But I would submit to you, if people look at it to the upside, why can't you look at it to the downside as well? And I think that's what a lot of you are also thinking, because you're talking about, hey, is anybody talking about how the transports are crashing? And, I'd have a hard time arguing that that doesn't look a bit like a crash. It's a pretty vertical move to the downside. Now, we are a bit oversold here, so I think we got to be careful of that. But let's take a look and flip the script, if you will, on Dow theory. So let's take a look, forget these extreme points here, and let's look at where support resistance is on the transports. And I would say that 14.8 is a pretty good level of support. So my point here is if the transports break that level, and look, we're not that far away, even though, again, we're a bit oversold from the 10-day moving average. So maybe we get a day or two of a bit of a bounce here. But if the transports break below 14.8, which is in essence breaking down towards the recent lows from September, I think that you could make a good case that using Dow theory, we're likely to come back down and at least test those lows at 420 on the SPY and the other markets. So, I even though it's technically not Dow theory to the downside, if it works to the upside, it should work to the downside. My personal opinion is I believe that it does. And I do think this is worth watching. And I like the fact that many of you commented on it. If you take a look at our comments underneath our videos, there's a lot of people that post very valid comments, and everybody has their own opinion. That's what makes markets, right? One person can think the market's going up, another person thinks it's going down. That's what makes markets. You have to have a buyer and a seller for every transaction, but they're very intelligent. So it's great to go through, and I enjoy reading the comments. And as I said, I try to respond to each and every one if I can. And so talking about the transports, I thought was something that we hadn't looked at much in TradeFinder, and made a lot of sense to do that tonight. So thanks for your suggestions. Thanks for watching on YouTube, looking at our videos, and we really very much appreciate you taking your time to do that. So now let's look at TNX. So talking about confirmation, right? The Dow theory, I think that's pretty good confirmation as well. When you look at interest rates, boom, to the upside. There's that little triangle. This little triangle I mentioned on Thursday at our insiders meeting, which by the way is for our subscribers, our alert subscribers only. So we do this TradeFinder on Tuesday night, but on Thursday night, we also have another webinar, and that's for alert subscribers only. And we have a much longer Q&A session. We try to get to every single question that every single subscriber has. We talked about this little triangle here, and I reminded everybody that Elliott says, don't forget the little triangles, and look at that. This is why we look at triangles. This is why we have an entire portfolio, the volatility portfolio, devoted to triangles, because things break out of them. And look at interest rates jumping to the upside. So for that spike to jump up like that, first of all, that's not a positive for the market, especially not for the tech stocks moving forward. But I think to jump that high, considering that we all know what the Federal Reserve is going to do, and the market is pricing that in, I think that was money coming out of bonds today. And so we'll see if that money moves back into the equities market tomorrow. If it doesn't, then holy cow. If money didn't come out of the bond market and interest rates still jump like that, I don't think that's a very positive thing. We talked in the last SPY update about the yield curve inversion. It was inverting again today. This usually doesn't work like this, where it inverts this long. We had the 530 inverted in addition to the 2s, 10s last week. The market is telling you with all kinds of flashing lights, whatever you need to catch your attention, recession is coming. Now, just to clarify that, when the yield curve, when the 210 inverts, 98% of the time there's been a recession that followed within a year or two. So it doesn't mean that it's coming tomorrow. It means that at some point down the road, we're likely to move into a recession. So can the market rally in the meantime? The viewpoint is the market looks 6 to 9 months ahead. So if the recession usually comes a year or two down the road, yeah, we could have a period of time where the market actually moved back to the upside before we start to look at earnings coming down, revenue forecasts, estimates, all that kind of stuff, and it really taking a toll on the market. Or the market could look at the fact that, holy cow, the Federal Reserve is just embarking on a rate rising campaign right as we have an inversion in the yield curve. I'm not sure that's ever happened before. It's usually separated. not to the point where they're raising rates right into it. There's a few people that are saying, okay, that's going to give the Federal Reserve a chance to pause and be a bit more dovish because of that inversion. I don't know. I think that's given the Federal Reserve an awful lot of credit. I'm not really in that camp. I'm in the camp, as if you've heard any of the trade finders or insiders or commentary that have done over the last few weeks, to think that the Federal Reserve is going to overshoot the mark. They're going to get too tight, too much quantitative tightening now. So we got QT instead of QE, and it's going to really significantly affect the economy. We'll see how it plays out. But I seeing this today makes me really want to see what happens in the markets tomorrow. Do we bounce off that 450 level and have a big update tomorrow? That meant money came out of the bond market and is ready to go into equities tomorrow. But if we sell off again tomorrow, right now the futures are pretty much flat, down 2 points. Then I think that's a really negative sign. I did think that the dollar breaking to the upside is a really good thing. As you know, I'm in favor of a strong dollar, so I'm happy to see this. I think that is a sign that maybe we're not going to go into as significant of a global downturn as we could, considering everything that's going on in the world. If the dollar were to break to the downside, I think that would be a signal of it. You've heard me again, if you've seen me do any of these recordings lately, I'm very staunch in the fact that I want a strong dollar. I like the fact that the dollar's moving to the upside. I wanted to see it hold 97 was really my line in the sand. And it appears that we've held 98 and we're breaking to the upside here. And we're trying to break out of this trading range already. I think that's a very positive sign. People could view that as like, well, just the rest of the world is concerned. And so the dollar is the currency of last resort, which is why I wanted the dollar to stay strong. And so money's moving in there. I don't really care what the reason is. I just think from an economic standpoint, a global economic standpoint, the dollar needs to stay strong. And so far it has. Looking at Bitcoin, in the last SPY recording, I left Bitcoin out, and boy, you guys let me have it on that. But we try to keep those videos in a timely fashion. We don't want to just ramble on forever. And so there's a lot of things to talk about, and there was a lot to talk about. We put a lot in that last SPY recording. So left Bitcoin out. It's been in a triangle. It broke to the upside and really nothing had happened. It hit 48. We'd already talked about that. So it'll definitely be in the next SPY update, but really didn't think there was anything to talk about. But y'all wanted to see it. So just wanted to make sure it was in tonight's broadcast. And there you go. We hit 48,000 and we've backed off. Nothing's happened. We're coming down towards that 44. You heard me talk about the fours with Bitcoin all the time. Support resistance is in blocks of 4, 32, 36, 40, 44, 48. So we got up to 48,000. We couldn't break above that at a 46 wave 4 correction, 46%. If we got up to 52%, I think that would still be fine, even with a 5-wave impulse pattern to the downside. If we break 44,000, then based on how things have gone, we're going to 40,000. I mean, these 4,000 things are almost that you can set your watch by them. That's what's going to happen. So we'll see if we can hold 44,000. We did yesterday, and at the time of this recording, we're holding in that area as well. So perhaps we're just coming down to test it again, because you can see that was resistance from December, February, March, and even April before we broke above it. So it's been a significant point of resistance. And when you break a big resistance area, often you come back and test it to see, okay, is old resistance now support? Like old support becomes new resistance. Same thing works in the opposite direction, kind of like what I was talking about with Dow theory. So can we bounce from the upside here? We can. We're just testing 44,000. But if we give up that 44,000, again, we're probably going back to 40. So I think that's something to pay attention to. The ASX continues to be really, really impressive. So we had to break from this pretty well formed symmetrical triangle, big run back to the upside. Now we're back near all-time highs. So Australia is like, yeah, there's nothing going on in the world. We're all good. And so we're right back to all-time highs, benefiting from resources, etc., are helping there, but things are great. That's a pretty vertical move. The only thing that makes me nervous about this breakout, I would have preferred to have seen the breakout more in a 45-degree angle, something along those lines. This is kind of vertical for me, and that makes me a little nervous that, all right, we've had a pretty vertical breakout. Now we're at resistance from the previous highs, and could we retrace that breakout move sooner rather than later? So if we can get above 7,600, then everything changes. Then we're in clean air and we could be off to the races. If we look at the DMI, you can see pretty strong confirmation there. We're not up to 40 yet on the ASX, or excuse me, on the ADX in the ASX, and the positive directional indicator is moving up. It's a pretty strong looking DMI confirming this move to the upside, even though we closed off of the highs. But I submit to you that that's normal because we are approaching that level of resistance. And if we take all this stuff off and just go back to that old 10-day moving average, you can see we're a little overbought. So if you're long the Aussie market, you wouldn't want it to break above that resistance area right now, because if it breaks above it and you're running out of gas, then likely that it doesn't hold, and then we fall back down. So consolidating underneath this level, gathering some steam, let the 10-day moving average catch up, get that energy going, and then boom, break to new highs. That's a more bullish scenario. Well, then you can come at me with, yeah, well, you said that about the Canadian market too, didn't you? And yes, I did. And the Canadian market broke above 40, and it was a bit overbought when it did. And I made the comment that now what we need to happen is to hold that 40 level, then let the 10-day moving average catch up. And it did. And look at today. Even though we closed on the very low of the day, it's still at or above the 10-day moving average and above that 40 level. So we were way up here on the high, and that was just a bit overbought. And I think if you're long the Canadian market, you would have preferred to see it close somewhere in here, not necessarily on the low of the day, but you could take a positive in the fact that even though it closed on the low of the day, it's still above the 10-day moving average. So the Canadian market has been extremely resilient. You did break above that 40 level when you were a little bit overbought, but it's held 40, which is what we talked about. And we'll see if we can gather some momentum and make a run up towards that wave 5. Trading the Canadian market right now, that's pretty simple. It's the fact of, as long as you hold 40, you can be long the Canadian market. You break below 40, then you want to get out. You look at the ASX, and you can trade that with EWA if you wanted to. I think you kind of are on pause here. See if we can break above 7,600 here on the XJO. You break above that, then you go long again. But I am a bit nervous again on the vertical nature of that breakout move. We are at resistance and we are overbought. I think the Aussie needs to calm just for a few days, and we'll see how that plays out. All right, so looking at some of the other markets, a few of the other markets. I know everybody wants to look at the Qs. If I leave that out, everybody loses their mind. So we'll go ahead and take a look at the Qs. I've talked about this before. I really think the Qs are going to underperform no matter what happens in the markets. Even if the markets have a good up year, I just think the Qs underperform the SPY and the Dow. We'll see at the end of the year. I've said that numerous times. So we'll find out whether I'm right or not on that. But we have a 61.8% wave 4 in this wave 5 impulse pattern to the downside. Going to have a hard time getting through that. Well, we're at a point here where I was talking about, I want to see what happens in the regular market tomorrow because of what happened with bonds today and interest rates. Well, look at this. 360 is a major point of support resistance here on the Qs. Can we hold that? We're testing it again now. We rallied above it yesterday after closing right on it on Friday. So can we hold it and break to the upside? Maybe. We'll find out. If we break below that, there is really nothing there. If we can't hold 360 on the Qs, then we're pretty likely coming down right to 320, and maybe not in a very long period of time because it was pretty quick to get up there. So that means there's no real support coming down. So I would think that the bulls are going to try to hold this 360 level If they can't, then again, I think we go down and test those lows at 320 very, very quickly. The IWM for the small caps, the Russell, and then we talked about how it tried to break out of that range. No dice, no follow through day. And look at today, big down day. So looks like we kind of want to go back down towards the bottom end of that trading range. The range for 2022 is 190 to 210, where it was 210 to 230 last year. So same story, different trading range on the IWM. And I just don't see anything that looks very positive for the market or the IWM, the Russell, to come down and test that lower level at 190. We're below all the major moving averages, the 10, 30, and the 50. We've given them all up in today's move. So you want to look at volume. You could take a little bit of positivity from the fact of, okay, yeah, well, it was an ugly day. We closed on the low, but we didn't even have average volume. So that's what you're hanging your hat on. If you're bullish on the IWM, you would like to see it take another shot at that 210, get above it with a follow through or confirmation day. Then you know where the next level is. If we can get above 210, then we don't have resistance till 230. But it doesn't look like that wants to happen to me. I think that we're probably back to being range bound again on the IWM. Now, this was really interesting to me to see this breakout. We talked about this triangle that was in the Nifty, and look at that. Clean break to the upside. Doji yesterday, no real damage done today. Pretty amazing. And we have a bullish cross here of the 10 crossing through the 30. It tried to do it back here around third week of March and couldn't quite get it done, but it did now. So, man, pretty interesting to see the Nifty breaking out of that triangle again. The only issue is we're right at the 60%. So right at the 61.8% fib correction level for the wave 4. So if this is going to really indeed be something to the positive side, it's got to break above that, break that wave 4 and disqualify this 5-wave impulse pattern to the downside. But regardless of whether it does or not, it's still pretty impressive that it broke to the upside out of the triangle. Now we'll find out how strong that move is again, because 61.8 is, to me, the strongest of all fib levels. It's my favorite fib level. And if you've heard me talk about it before, you know that I mention that quite often. So we'll see how that plays. So, you know, the next couple of trading days are going to be really, really interesting in the markets. Here we are back to the DAX, moving down again from that wave 4. Talked about that last week, where at least we had a little bit of a bounce, but the wave 4 right at a 50% corrective level, starting to head back down. And that 3 was a wave 5 that relabeled to a 3 3 times. And as I mentioned, I don't know that I can ever remember that happening before. So we'll see how the DAX plays out, but it's looking like maybe it has rolled over. You could still bounce up to the 61.8% wave 4 correction level, but right now it looks like 50 is holding. We're down below again, all the major moving averages there as well. So I don't know. I don't see a whole lot of positives out of the DAX. Looks like we could be headed for something lower there. All right, as far as taking a look at our case study alerts, I thought I would just show you everything. The market has, you know, if we take a look at what the market's done, our S&P, you can see, well, we went down in January and February. We had a pretty significant move lower. And then in March, we had a pretty significant bounce. And a lot of people are saying, I don't know how you trade this market. You're getting whipsawed. If you listen to the financial networks, opinions are all over the map as far as what's going on. It's been pretty challenging trying to figure out where the market's going to go from here. But here's our record. You can see 3 items selected. That's our 3 primary portfolios. That's the impulse, which is directional, the volatility, which is the triangles. And so we don't pick a direction on those, just let them break either direction. In the time strategy, which is now AI based, which is AI determining whether or not stocks are likely to stay in a trading range. So here's the alerts that we closed for the months of February and March. And you can see here, pretty good record there. A lot of wins. I don't need to show you the details. You can look for yourself. I'll just scroll down a little bit. And oh, there's a loss down there. Trade ID number 531 there on CC. That was a loss, but it was only an 8% loss. $40 loss. And right above it on SLV was 106% gain. So we've got all these gainers in these different portfolios, and then the loss that shows up is an 8% loss. And then we continue to come down, and there's another loss on CC. That wasn't a good stock for us, 17% there, and an awful lot of wins again. And then we come down, and you can see the XLF there with 25% and ALLK 7% loss again. So that one's actually in January. So an awful lot of wins, 2 losses that were really minor in nature. And I think that we've done one hell of a job for the kind of market that we've had. That's not a lot of alerts. I understand that. We haven't been as active as we normally are, but there is a time to be really active, and there's a time to be cautious and patient. And when the market has a VIX that's consistently over 30, and you're having big downward moves followed by big upward moves, just when everybody thinks the market's going lower, then it bounces back to the upside, and now we turn and roll back over again. It's like, pick your spots, find the best patterns, and trade those. And so that's what we've done. And you can see that not a whole lot of time in these trades either. Look at this. Okay, the XLV was 78%, and that was a nice correction there. Talking about making adjustments. We made a nice adjustment there in a position that was losing, turn it into a gainer. Big fan of adjustments when the situation is right. Every situation is different. Sometimes you take the position off and close it out. Sometimes you adjust it 9 days, 17 days, 1 day, 18 days, 24 days. So as you can see, we weren't in these positions for very long, generating all these gains. So just thought I'd go through and show you that. And if you've thought about becoming an alert subscriber and you haven't yet, why not? If you're having trouble figuring out this market like most everybody else has, come along with us. Even give the time strategy a try if you don't want to do any of the other ones, because that's being picked by AI, artificial intelligence, which I think is the future of technical analysis. Try that one. No better time to come along and be an alert subscriber than right now, I don't think. So our results are right there. We're as transparent as you can be. We post everything. Those little graphs there show you what every position looks like every single day. So go ahead and become a subscriber. We only charge month to month, by the way. There's no commitment. There's no contract. There's no year in advance, none of that stuff. You just pay for a month. Try it out. You don't like it, you cancel, and you can cancel. You don't have to ask us to. So it's not like one of those things where we do everything in the world to keep you on the hook. You don't want to be here, then go away. We're here for the people that want to be here. When we take a look at our previous case study considerations, look at this. So Fifth Third Bank, if you remember, that was originally started as a bullish position on February 8th. Now, last week I said what we would do is morph this into a triangle, a strangle, because of the triangle. That's what we would do for our alert subscribers, and suggested that, made the notes of it. If you watched last week's recording, you know that's what I said. And then watch what happened. Boom. Well, there you go. That's how you make an adjustment. So you turn a position that wasn't really doing anything, would have been at a loss over time decay. And so you morph it into a triangle because it's now in a triangle, let it break either direction, and then boom, you get a fully directional move to the downside. And guess what? You just turned your loss into a gain. That's what adjustments do. And that's why I'm a fan of them. We had a subscriber today that was concerned because we made an adjustment on a position. Listen to this. So we made an adjustment on the time strategy where we had 88 cents of extrinsic value left in our April option, but the May option had $4.58 of extrinsic value in it. So we went ahead and closed out the April one early forfeiting the 88 cents because we wanted to get in touch with that $4.58. Because if the stock goes down, extrinsic value turns into intrinsic value, and that doesn't erode. Intrinsic value doesn't erode, only extrinsic value does. So to forfeit a potential to get $4.58 to get 88 cents makes no sense. It's a smart thing to do. And we did that. And somebody's like, I don't know, this adjustment stuff, I don't get it. It's prudent. If that stuff confuses you, then you need to become a subscriber and sign up for our Option Accelerator course, which is covering, it's kind of marketed as covering the basics, and it's free for subscribers, by the way. You don't pay anything extra. If you're an alert subscriber, the course is free, and it explains this stuff to you, so you're not confused by it. If it's confusing to you to potentially forfeit $4.58 to capture 88 cents, then you definitely need to be in this class. It was a really smart thing to do, and I was totally taken back by that comment. But intrinsic, extrinsic, and all that kind of stuff, if those things are terms you've heard but you don't fully understand them, you're not alone. A very small percentage of people understand them. That's why we create a course for free for our alert subscribers, because we want the most educated subscriber base that we can have, because educated traders are successful traders. That's how it works, and it always will. And we pride ourselves on our education, and we want our subscribers to be educated, and we want them to be the most educated option traders on the planet. So we put a lot of effort into the educational part of it. The alerts are great, but we really spend a lot of time on the educational side of things. So we're crossing that one out. That's how it works. And we made a good gain there. Now this one on Vivo, this was bullish. Now we talked about potentially moving this one into a strangle as well, because as you can see clearly here, we have an ascending triangle. Now we're over $1 above where the entry price was, but some time has gone by. Had you put a spread on, you probably have a small gain. If you only bought calls, maybe time decay has you at a little bit of a loss. But when you look at the ADX, it's too high, and it looks like it wants to break to the upside out of that triangle. So I'm going to leave it to the fact that potentially the ADX looks strong, but I don't like the fact that the positive directional indicator here has broken below the ADX. So to me, we're going to close this one off. So perhaps you got a little bit of a gain here, maybe break even, whatever. But I don't want to risk that breaking to the downside. And even though it's an ascending triangle, it could break lower from there. Any triangle can break either direction, with the fact that the positive directional indicator has broken below the ADX. So there's better things to look for out there. So we're closing that one off as well. You could say that, hey, at least it didn't go lower than that, but it didn't break to the upside either, did it, when the market moved higher? So we had the market bouncing off those lows, and this stayed in the trading range. So I think, take a tiny gain, break even, let's move on, let's look at something else. And then SIL, remember this is the miners, and you can see here where we have the ascending triangle here, and the difference that we have is there's the low ADX, so the ADX is down under 13, so we're going to get some sort of a break here, and that was at 36.52, and right now it's at 36.43. So nothing's happened, hasn't broken out yet, and you can see that basically we're still in an ascending triangle. Hadn't really changed. Nothing's happened. So we'll hang in there. Nice looking triangle, low ADX. It's going to move, so we'll give it time to move. And then last week, as I said, here's what we looked at. We were too vertical, and we had this gap. And I said, we're not even going to look for an alert. We're going to buy puts on the market because that's too vertical. And with the gap is going to get filled. I let you guys pick. We put it to a vote, and you voted for the SPY. So we bought puts, or that was our case study consideration for last week, was to buy puts, and boom, boom. There we go. 2 days. That was it. In and out, 2 days. You should have been, if you were following along with that. If you stayed longer, then you got greedy. That wasn't what the plan was. The plan was to satisfy this overbought condition and fill that gap. That happened in 2 days. So that should have been a really quick gain. So that one's gone too. So really, the only position that we have left of all of our case study considerations over the past several months is the strangle on SIL. That's it. That's all we got left. We've closed everything else out. That's pretty amazing. And if you've been watching this over the past years, we've only had a handful of losses on the case study considerations through TradeFinder. So pretty impressive record, I think. So yeah, we're going to be spending a little bit more time on the Q&A for the next couple of weeks, because we don't have a whole lot to talk about as far as old case study considerations. Let's take a look and see if we can find one for tonight, and then we will take some questions. Wow, there's actually 3. If you're wondering what this software is, it's called Profit Source. You can find more information about it at hubb.com, hub.com. To me, it's the best Elliott software on the market. I've tried all the ones that I know to exist. I'm not saying I've tried them all, but I've tried all the ones that I know to exist. This is programmed directly from the actual algorithm that Ralph Nelson Elliott wrote. The mathematical, that 20 pages of coding stuff that I don't understand, the beautiful mind stuff. That's how it's programmed. It's no individual's adaptation. There's a lot of them that are individuals' adaptations out there. That's not what this is. This is actually the pure Elliott Wave algorithm. That's why I really like it. And if you're an Elliott Wave Options Alert subscriber, the folks at Hub added these on, so you get all these additional pre-computed searches. Now you can run searches, create your own criteria, etc. It takes a few minutes for it to run, but when they're pre-computed, just boom, the click of a button, it's instantaneous. So that's the difference there. I use it. A lot of our subscribers use it. So the folks at Hub added those in. All those ones that say EWO are my searches. The other ones are things that they've added in that they thought our subscribers might enjoy looking at. So first thing right off the bat is I want to look at this NVO. It's been on there before. Now the problem with this one is I've looked at this numerous times and the options are illiquid. There's not a lot of liquidity here. So if you wanted to do something with this, it looks awfully good. And man, look at that DMI. The DMI is suggesting, because you take a look at this and you see that we're right here at resistance. You could make a case for, wow, that's really a nice ascending triangle. It didn't look anything different than what the SIL looks like, except that this pattern here, we just actually qualified the DMI. So it triggered, is what I like to say, for an upward move. So the DMI is suggesting that you're going to have an upward breakout. I'm still suspicious when you have triangles, because triangles can break either direction. But when you have a DMI that looks like that, I think the likelihood is pretty high that you're going to break to the upside. Again, the issue is the liquidity in the options. So if you're okay with that, if you're okay with paying wider spreads, I think we're going to be hard pressed to find something better than that. But please understand that that's going to be an issue there. So let's take a look at these other two and see if there's anything. Wow. Old Jack Henry's off to the races here. If we take a look at the DMI, man, that looks pretty good too. Add the Elliott wave on, it's in a wave 3. It's making a nice run. Perhaps that's something that you like a little bit better than NVO. But look what the software has found. Big down day today, and we've got 2 really nice upward moving patterns. This stock moved up 1.5%. I would say that well, it's not as overbought as I thought it was going to be. I was going to say there's probably a little bit overbought with that vertical move. I think there's a great chance we hit that 220 level. We haven't gotten to 40 yet, but we are maturing in this upward move. But we're at 203, so getting to 220, I think that is a possibility. Now, the interesting thing about Hershey's is, and man, we looked at when. Was it in TradeFinder, or was it the insiders meeting where we looked at when? And I was talking about how the gambling stocks, the sin stocks, are defensive sectors, and money is moving into defensive sectors. And so the rotation is there, kind of confirming what the transports are showing, that there's rough times ahead. look at that with that DMI and moving to the upside. Now, Hershey's is a defensive sector, right? And it's not just chocolate anymore, right? They're far more diverse, but they're in the food space. And that's kind of a defensive minded sector as well, as far as, people are going to find a way to eat no matter what's going on. And 89% move there. And it looks like we have more to go. So perhaps the safest one is we'll go ahead and put down for tonight 4-5. Our case study is going to be Hershey's, and that gives us some protection in case the market does continue to the downside, because you can see when we had this big move lower in the market from the beginning of the year till middle of March. Look what happened there. Beginning of the year till the middle of March, upside there on Hershey. So good defensive play there. If you're concerned about where the market's going to go, that's going to be our case study consideration for this week. All right. So with that, I'll go ahead and bring Zach back in, and we'll open it up to the Q&A.
Sounds great. We've got tons of great questions coming in on both Zoom and YouTube. So I'll pass through as many as I can till time.
All right.
We'll start out with this first one from Tobago from YouTube. This might be something for future sessions to consider, but he would like a review of the NAS 100. So again, maybe for future sessions, I know would.
Well, the Qs are pretty close to the NASDAQ 100. But if he has a particular symbol that he wants to look at, but the Qs are not much different than the NDX is the NASDAQ 100. We'll take a look at that. But you can see those charts are pretty doggone similar. So a lot of people look at the Qs instead of looking at the NASDAQ 100. So there's not a whole lot of difference there. Looking at the pattern, you can see that we're still at that same wave 4 corrected level, right at the 61.8% level downside. So instead of being 360 on the Qs, we're right here at 14.8 there on the NDX. I don't see much of a difference between this and the Qs. So I think that, if it can hold that level, maybe, but I'm still saying that the NASDAQ 100, the Qs, tech stocks, whatever, are going to underperform the rest of the market. I just don't see how you can be really bullish on those moving into an environment of higher interest rates. Now, if you're looking for a bearish trade, then I think you're in the right place. So if you're expecting it to move to the downside, then I think you're there, but you do want to let it break 14.8 there with a follow through day. And then you have plenty of room to the downside on the NDX. So, but as far as moving to the upside, I don't see a big move higher. I mean, I think they outperformed on this little bounce. I don't see that outperformance the rest of the year.
All righty. Thanks for that, Rob. Transitioning back over to Zoom, Susan asked, it seems before aftermarket blips like the 425.44 and the SPY this morning before the 9:30 open impact the CCI and the DMI as well, talking about the 3-minute chart, but expect other charts could also be impacted? Thanks.
Yeah, if there's, and that's the issue, right, with the pre-market, is there's less liquidity. So there's less trading, more trading than there used to be, but yeah, they do affect it. And the less liquidity, you can get some extremes, and that kind of throws the charts off. And that's why a lot of traders sit out the first hour. And it's not as significant as it used to be. We talked about this several recordings ago, where the first hour was called amateur hour. That used to be a really big thing. It's still a little bit there. I would submit that in the peak of the Robinhood meme days, it was back. The first hour was insane. And so there's a lot of really smart traders that just sit the first hour out. So, what happens overnight, let the first hour settle down, and then start to look at the patterns. And I tend to do that myself as well. And what I found is looking at the intraday markets and dabbling around a little bit there, kind of tend to stay away from the first hour and even the last hour when the VIX was high. It was fun watching things move in the last hour, but it got to the point where it was very difficult to, the patterns would change so quickly in the last hour because of all the volume that was coming in. So staying away from the first hour and the last hour, and you had that really nice midpoint of the day where the patterns just played out absolutely spot on. And that gave you plenty of time. If you wanted to day trade Elliott wave or whatever, you could do that. But again, I would submit to you, stay away from the first hour and the last hour and let that chunk in the middle be your trading time.
Awesome. Thanks for that insight there, Rob. Back over to YouTube. Pobs asks, seems like Goog is also in the beginning of a wave 5 down. Can you confirm?
I don't know if it wants Goog or Google. Googl. Let's see if the Googl is different. The regular one had a quick wave 5 to the upside, and when Elliott would look at this, he would say that that really wasn't much of a corrective move there on the wave 4, followed by not much of a corrective move on the wave 5. Isn't it interesting that we corrected 28%, we extended 28%? I would say that this looks like it's in a massive triangle, and I'd like to see the ADX a bit lower than that, but for Google, that's a pretty low ADX. But the fact that we corrected and extended the exact same amount, to me, makes the mouth of the triangle. I like that as a triangle, which means some sort of a significant break is going to come out of Google, and that's like what, 2480 to 3040, 600 points, something like that. Yikes. For most people's sake, let's hope that's to the upside and not the downside. So try GOOGL and see if the pattern's different there. Nope, really no different. Same thing, and I still like to look at that as a triangle. I mean, it's right between where the high was in February and where the low was in January, and just looks to me like something's getting ready to happen there, but I have no idea what direction. Going to be fun to watch, though. As far as Elliott wave patterns, even though it's not in an Elliott wave pattern now, although you could argue that a triangle is an Elliott wave corrective pattern, the number one stock for me in my trading career since I started trading Elliott wave in 2001 has been Google. I've done more trades on Google than any other individual security. It's very liquid, obviously, and we all know the more liquid the issue, the more accurate Elliott wave is. And so that's number one. So anytime somebody asks about Google, I'm always really interested to take a look at it.
Absolutely.
Also gave me the highest profit I ever made on an individual trade. It was 1,000% call butterfly, 1,000% gain on an out of the money call butterfly on Google once. That's my best trade ever.
It's always a fun one to watch and certainly to interact with those type of results. So back over to Zoom, James has a couple symbols for you. First one being NVO.
EN or IN?
NVO, as in nano. Like just NVO.
Oh, the symbol. Oh, when you were saying N, I thought it was IN or EN. All right, I got you. I'm with you now.
No worries.
Well, we just looked at that. We just looked at NVO.
Apologies. KHC?
KFC?
KHC.
KHC. No, I thought somebody was hungry. Oh, this is Kraft Heinz, so pretty close. Still staying in the food space. And yeah, I mean, I like this area. We just looked at Hershey's, and that was our consideration for the week. So I think you're right on being in this space here. So obviously somebody's looking at our search results with that NVO one. And I really like NVO, but I'm just saying that the issue there is that it's illiquid. So you're going to have to pay a big wide spread. And, it's been really, really tempting numerous times because the patterns have been good and the patterns have worked out too. by the way. But there's not a lot of liquidity there. Different story on KHC, and I like this one. 48%, so a 50% corrective level. I think it's in the right space. And you look at the DMI, I love this one. I like this just as much as Hershey. So yeah, I really like that one. I think it's a good one, and it's safer.
Agreed. Thanks for that, Rob. A good question here from YouTube, from Irv. This is back in relation to Bitcoin. Based on the Bitcoin chart micro scale, it looks like it wants to go higher to around 50 to 51K. But if we break 44K, does that invalidate the current Elliott wave count and could see the macro count play out?
Well, I would say that with this wave 5 impulse to the downside, that the count is currently lower. So if it breaks above 48,000, that's when we could invalidate the count and look to move higher. We had this ascending triangle pattern right here with 44,000, and then here we broke above it and we're back to test it already. That's not that unusual, because one of two things play out here when you have that. So you get a breakout and you come back down to test the breakout. Sometimes you go boom, right back to the upside with a nice run. Other times that was a false breakout because there was no follow through day and the big move is lower. So I submit that Bitcoin still, you have to treat that as if it's in the triangle and it could still break in either direction. But if we can break above 48,000, I think we're off to the races to the upside. But it's got to do that with a follow through day, and it got up there and it couldn't do it yet. So I think we have to respect the 5-wave impulse pattern to the downside until it can disqualify it, breaking above 48,000 with a follow through day.
All righty, thanks, Rob. A question and a funny comment here from Jess on YouTube. It says, Rob, don't get me excited about a drop to 320. In my head, we're still headed to all-time highs.
You could be right. The problem is in running to all-time highs is the fact that sentiment has changed. Right. I mean, it was when we were going lower, it got so bearish that we bounced to the upside. Well, quickly, everybody got back on board, right? All the meme stuff started coming back out, GameStop and all that started showing up again. And all the things that were occurring to the market never goes down scenario. We put out this recording. I don't know if you saw it on YouTube, but is it time to buy GameStop? Because they announced a split, but they didn't really announce a split. They announced that they're trying to get more shares authorized by the board to go from 300 million to 1 billion shares. And the plan is, in my opinion, that they're going to sell more of those shares because they didn't commit to actually what the split was going to be. So you didn't know how many of those shares were going to the split. And so I was like, be wary of this. Not all announcements of stock splits have the stock run higher into the split, which is what usually happens. And look what's happened with GameStop. Ever since then, it's gone straight down. So far, our note of caution has been pretty spot on. But anyway, going back to the comment on moving to all-time highs, it's a little harder now due to the fact that sentiment has changed. It went from really, really bearish to really, really bullish pretty quickly. And that's going to be, I think, a big stumbling block to move to all-time highs. Perhaps we need to go lower first and really wash out the selling, then maybe have a chance to run to all-time highs. I don't know. We'll see. But again, that's what makes markets. And I always appreciate the commentary and always appreciate opposing views. I'm not the market god, so I just read the charts the way I see them, and it's nothing more than that.
It'll certainly be interesting to see. And just to continue on, just had a further question there. Speaking of the VIX, under 20 for days on end, do you see all-time highs before reality sinks in?
Well, I actually was surprised that the VIX stayed down here and traded under 20 for several days in a row. You're right there. The thing that concerned me was the fact that the move down from almost 35 to under 20 was really vertical to the downside. And that makes me concerned that perhaps we could at least have some sort of a snapback to the upside, because you've heard me say, if you've listened to any of my recordings, I don't like it when things go vertical. And when stocks go vertically up, often they come vertically back down. That works for anything, including the VIX. And often you can see these vertical moves, and they come vertically back down. This time we went vertically down. And so, theory, it works in the opposite direction. Kind of the same thing that we were talking about with Dow theory in the very beginning of the recording, that if Dow theory works to the upside, it should work to the downside as well. So I'm a little concerned about that. But if we can break back below 20 and start heading back down towards 15, then you have a chance for your all-time highs. So I think the VIX got to get back below 20. No snapback rally that I'm concerned about out of the VIX, and we start to drift back down towards the 15 level. Then perhaps you get your all-time highs. I mean, you've got other markets doing it, right? I mean, so there is, you have a leg to stand on, if you will, because of Australia and Canada. Those markets are back to, if not exceeding, all-time highs. So, why couldn't the U.S. market? It could. I'm just pointing out things that I'm concerned with. And I think if it doesn't happen within the next few months, it's likely not going to, because that recession is coming. The recession is coming a year or two down the road. So if we're going to go to new highs, we need to do it quick.
Absolutely. And it's an interesting topic to discuss. So thanks for that insight there. Just passed through his thanks as well. Back over to Zoom, Suresh asked, how much does a security have to move above or below its 10-day moving average percentage-wise to be thinking of a reversion to the 10-day moving average?
Boy, what a good question. And I've been actually waiting for somebody to ask that question, and I don't have an answer for it because I don't have a percentage. It's a visual thing that I look at the angle, the separation, just the whole expression. No security in any time frame gets very far away from the 10-day moving average. And you would think that, okay, well, there should be a percentage. And to be honest with you, I've never gone through, and I mean, the amount of data that you would have to go through to analyze to figure it out is monumental. Could it be done? Absolutely. The data exists. So that could be done. I've just never done it. So I don't have a specific answer to it. It's a really, really tremendous question. One that I expected we'd get. I just don't have the answer for it. And you get a feel for what the security is, when it's moved away from the 10-day moving average, how far has it moved before it snapped back? You get too vertically away historically for that security. Is that a lot? Is it not a lot? And then you eyeball it. But there should be a percentage, and I'm sure it's out there. I've just never taken the time to do the math to figure it out.
All righty. Well, we are 5 minutes past time, so I'm happy as always to stay on as long as you are. You just tell me how many more.
Well, we'll take one more. And
all right, sounds great. We'll finish on this last one from Mike. Can you look at OZK, please, and thoughts on banks in this environment?
OZK, Ozark. Oh man, Mike, tough space. The financials are just not doing well. Remember, I don't know if you've been watching a lot, because we got a lot of mics. We have a lot of mics that are subscribers, so I'm not sure which one this is. But with the financials, the issue is, this is a really good regional one. But the issue with the financials is the yield curve. When the yield curve flattens, I had talked about why I was concerned. This was before the market made the big move to the downside. Why aren't the financials doing better? Interest rates are going up. Why aren't the financials doing better? Because the yield curve was flattening, and then the yield curve inverts, which means they're losing money. So not only is it a tough environment for them to make money, if they lend, they're locking in a loss. So do they want to do that? No. So what's the other side of the coin? Don't lend. Can you make any money if you don't lend? No. So their choices are don't make money or lose money. That's really where the financials are. It's that simple right now. So, I just don't see for a while, until the yield curve starts to steepen again. It's going to be a really difficult time for the financials. So it's not the same thing as tech stocks, because tech stocks are just going to struggle in higher interest rates. Banks and financials can do well in higher interest rates if the yield spread is wider, if the yield curve is steepening. But when the yield curve is flattening or inverting, they have no chance. So again, their choice is don't make money or lose money. That's really what their choice is. And then we look at this and you can see that we've got really nice zigzags here. We've come down to the 100% extension on that one. So it looks like maybe down to 40 on Ozark. And then there's another zigzag right here within the wave C. So you can see it's just kind of working its way down, which means we could go as low as 38 there. And that's a good bank. It's a quality bank. So, I mean, you're looking at a good one. It's just an environment where they have no chance. They just have no chance. So I can't, I'd stay away from financials and tech stocks for now. Yield curve starts to steepen, different story for the financials, still bad for tech. So that's what we'll do. We'll wrap things up. I hope you enjoyed this session. I thought this was a really good one. I enjoyed it myself and appreciate your time. Say this every time, but really passionate about it and really sincere about it, that time's the most valuable asset we all have. We very much appreciate when you devote some of your valuable time to us. We in turn try to make it a informative and educational use of your time. So thanks very much. Look forward to talking again next week. Take care, everybody.